Hello and welcome to Lecture 4 of Financial Statement and Analysis. Today's lecture topic is on reformatting the financial statements. When we look at our business analysis framework, reformatting the financial statements sits in step 2, which is on analysing the information, and it sits here, reformatting to uncover business activities. So we do this after we've completed our accounting analysis and we have a deep understanding of the firm's accounting policies. We then need to reformat the financial statements, which is going to allow us to unlock more information about the company and allow us to do a better ratio and cash flow analysis, which is what we'll be focusing on in the next lecture. The learning objectives in today's lecture are pretty simple. We have two main learning objectives. The first one is to understand why it is important to reformat the financial statements. So that's the theory side. And then the second learning objective is how to reformat the financial statements. So that is the practical side of doing things. We're going to start our discussion by discussing return on equity. Return on equity, or ROE, is one of the most common financial performance measures that gets calculated. ROE is something that you would have learned about in your introductory accounting subjects, and in the simplest form, the return on equity formula is equal to the net income or the net profit of a firm divided by its average owner's equity. So we can express this formula as ROE equals NI, which is your net income or net profit, divided by the average owner's equity, last year's equity from the balance sheet, plus this year's equity from the balance sheet, divided by 2 is your average owner's equity. Return on equity is the most common and important financial performance measure. When we're talking about value in a business, we mentioned that value is created when a firm earns a return higher than its cost of capital. When we talk about the return the firm is creating, we're referencing the return on equity that firm has actually earned. So it's going to be very vital to calculate return on equity accurately for us to value our companies. Let's start with an example of return on equity. Example A here, I've saved up $1 million to buy an apartment in Sydney. After 4 years, I decide to move on and I sell that apartment for $1.2 million. That means I've generated a $200,000 profit on that sale over the 4 years. So let's put this into the formula. My owner's equity would have been the $1 million that I saved and invested into that apartment. My profit would have been the $200,000 difference between the selling price and the purchase price. And as I plug those numbers into the formula, my return on equity would be 20%. My profit of $200,000 divided by the $1 million initial owner's equity gives me an ROE of 20%. Let's change up this example and make it a little bit more realistic. It's hard to save up $1 million to buy an apartment, so most people will go to the bank and borrow some money. So let's assume we buy the same apartment for $1 million, but this time we have saved up $500,000 and we've gone to the bank and borrowed the other $500,000. That is, we've got some debt and we've got some equity this time. So after 4 years, I still sell that apartment for $1.2 million. So if I was to calculate my return on equity this time, there's a few changes that would be made. First of all, my owner's equity this time was only $500,000. The bank also lent me $500,000 debt to buy that $1 million asset. My profit is no longer $200,000. That's because I've sold the apartment for $200,000 more than I bought it for, but I also had to pay interest on my bank loan. So 3% interest per year for 4 years times 500,000 gives me 60,000 in interest expense. So now my return on equity would be 28%. That is, my profit of 140,000 divided by 500,000 in owner's equity gives me a return on equity of 28%. This is a very simple example, but it illustrates a really powerful point in business. Our return on equity is influenced by how we have financed the transaction. So even though I had the same operations of buying and selling that house and selling it for $200,000 more than I purchased it for, the financing decision, that is how much we borrowed versus how much equity we used, resulted in a different return on equity calculation. This is called leverage. As you borrow money to invest into your business, you can lever up your returns. On the downside, if the value of the house decreased, I would have levered up my losses. I would have lost more money than if I didn't borrow. So the lesson for this is that ROE, our return on equity, is influenced by both our business's operations and also how the business finances those operations. So with that lesson learned that the financing decisions influences our return on equity, we can expand on the traditional return on equity calculation and introduce what's called the DuPont Analysis. So the traditional DuPont analysis that you would have also looked at a little bit in your introductory accounting subjects breaks up a firm's return on equity into its operating performance and its financing performance. Specifically, we're going to use this formula here. We're going to say the firm's return on equity is equal to their net income divided by sales. And down here, I've called that the profit margin. You then multiply the profit margin by sales divided by average total assets. And here I've called that asset turnover. So the profit margin times the asset turnover ratio. These are both operating aspects of our business. And then we multiply by total assets divided by average owner's equity, which is the leverage or the financial leverage of the business. So DuPont Analysis now breaks up the return on equity into three components. We have our profit margin, our asset turnover ratio, and our financial leverage. All three of these aspects will determine the return on equity your business is able to generate. This is a really powerful analysis because we know that the return on equity that a business generates is a very important way of measuring its overall performance, and it indicates if it's creating value. We know that return on equity is influenced by the financing component and operating components of the business. So now we can drill into that a little bit more and think about specific operational aspects of the business, that is the profit margin and the turnover ratios, versus the financing effect. And we can start to understand how a business is actually generating its returns. What is the most important thing that generates this business's return on equity? So that teaches us a point that to understand a business's performance, you have to have a good understanding of its operations, as well as its financing decisions that it makes. Let's do an example to illustrate the DuPont analysis. Using that same example of buying an apartment in Sydney where we generated a 20% return on equity by saving up $1 million and selling the apartment for $1.2 million 4 years later, we can now look at how the profit margin, the turnover, and the leverage built together that 20% return on equity. The profit margin, my $200,000 profit, divided by my $1.2 million of sales revenue, was 16.67%. My asset turnover ratio was the $1.2 million in sales revenue divided by my $1 million asset base, gives me an ATO of 1.2. And my leverage, I had all equity. So $1 million of assets divided by $1 million of equity is a leverage of 1. I did not have any debt. So 16.67% profit margin times my 1.2 asset turnover times my 1 leverage equals a 20%. This is exactly the same as if we did the return on equity formula as the normal profit divided by. But what we learn is how the profit margin, turnover, and financing components influenced our returns. For our next example, when we borrowed money from the bank to help finance our apartment purchase, we can break down the DuPont analysis as well. My profit margin, I earned a profit of $140,000. Remember, I had that interest expense, which lowered my profit, and I divide it by my overall sales of 1.2 million, and I get a profit margin of 11.67%. My asset turnover, same as the previous slide, is still 1.2. And my leverage now, I had $1 million of assets, but I only had 500,000 of equity invested. So my leverage is 2. I can do my DuPont analysis. Profit margin times turnover times leverage gives me a return on equity of 28%. The important lesson here is that the interest expense lowered the profit margin. Now, this is important to understand because the financing decision, that is how much money we borrowed, we know that affects our return on equity because it affects the leverage. However, it also affects our operations. And that's a bit of a problem for us. We don't want our financing decisions influencing our operating performance measures. So this example here shows a powerful point. Borrowing more money does change your leverage, but it can also change your operating performance as well. So just to reiterate that point, the financing decision of choosing to borrow money to buy that apartment influenced our return on equity. And we knew that was going to happen because it changed our leverage. However, what it also did is it changed our measure of operational performance. It changed our calculation of the firm's profit margin. The profit margin was decreased due to the increased interest expense, lowering our overall net profit. When we're analyzing businesses and we're comparing different businesses and looking at their return on equity, we want to make sure we're comparing the operational performance of the firms because the firm's operations are what actually create value. So Traditional DuPont analysis has a little bit of a problem here. It doesn't cleanly separate the operating and financing aspects of the business. Our financing decision influenced our operating performance measures such as. So why does it matter about mixing up our operating and financing activities into the return on equity calculation? Well, when we're analysing firms' value creation, we know that firms create value when they earn a return higher than their cost of capital. Just to illustrate with that previous example of borrowing money to buy a house, if the interest rate on that loan to borrow money to buy the apartment was actually higher than the 5% return we were getting each year, we would have lost value. So you can only create value when you generate returns higher than your cost of capital. So if you borrow money for a higher interest rate than you are generating in your return, you destroy value. If you borrow money at a lower interest rate than the returns you generate from the investment, you create value. So we need firms to have a return on equity larger than their cost of capital to create value overall. And we know that what actually creates value for a firm is their operations, that is, how they use assets and liabilities to help buy and sell their products or services. The financing activities of a firm simply distribute the value. Raising cash for the operations or dispersing excess cash from operations to shareholders or debt holders is a value distribution. It doesn't help you create value. So generally, financing activities occur at the cost of a firm's capital. That means they don't create value. Now, there are some exceptions, especially in financial services firms such as banks. However, for normal operating firms, the financing activities do not create value for the firm. Let's look at some examples for that. Here we have a company that has 100,000 shares outstanding and a share price of $45 per share. So market capitalization is the number of shares outstanding times the share price per share, and that would be $4.5 million in this case. The company decides they want to sell more shares. They're going to raise more equity. They decide to sell an additional 10,000 shares for $45 per share, the fair price of their shares. Does this transaction actually create value for shareholders? Well, what happens? The market capitalization increases. They've sold an extra 10,000 shares at $45 each, so the market capitalization increases by $450,000. The share price is going to stay at $45. No value is created by simply selling shares in your own company. You can't magically create value by selling shares in your own company at the fair market price. To create value by selling your own shares, you'd have to sell the shares at higher than market price. So the company decides to try that out. They've still got the same amount of 100,000 shares outstanding at a share price of $45 each. They decide to engage in a financing transaction and sell some shares. They decide to sell the shares for $50 per share. Does that transaction create value? No. No one's going to buy the shares for $50 if they could buy them on the market for $45. So by trying to sell the shares at higher than market price, no transactions will occur. No one's going to be silly enough to buy the shares for $50 when they could go and buy them for $45 at a cheaper price. So no value is created here. No transactions are going to occur. You are unable to create value by selling your own shares at higher than the market price. No one's going to be willing to engage in that transaction. Financing transactions can sometimes destroy value. So as an example, this company wants to sell more shares still. They decide to sell the shares for lower than the current market price at $40 to really make sure they get the sales. They're really desperate for the equity and they want to ensure they get this sale through. So they provide a discount. They're selling the shares for $40. What happens? The market capitalization increases by 400,000, the extra 10,000 shares times $40 each. The share price would then drop to $44.55. Our total market capitalization divided by the total number of shares would give us $44.55. That means the share price would have dropped from $45 down to $44.55. The share price has gone down. That indicates destruction of value. And this is called a dilution of shares. Okay, so sometimes value can be destroyed with our financing activities, but it's very difficult to create value. So just to repeat from those three examples there, the first example we saw selling the shares at the current market price, the share price doesn't go up. We don't create any value from that transaction. When we tried to sell our shares for higher than the share price, no one's going to buy that. So again, we can't create value. However, if we have to sell our shares for less than the current market price, we can destroy value for existing shareholders. This indicates financing activities generally occur at the cost of capital, so we don't generate value by generating returns higher than our cost of capital with our financing activities. In your introductory finance subject, you've probably learned a little bit about Medici and Miller. They had this theory, the dividend irrelevance theory from 1961, and it shows how the value of a firm does not change based on if the firm chooses to increase or decrease their dividend payout. That is, dividends are a financing activity. They are a distribution of value. They don't indicate actual value creation. So dividend payments are another example of a financing activity, and they also don't create value. Dividend payouts don't create value. They don't generate returns higher than the cost of capital. So the Medici and Miller theory is another example of how financing activities don't generate value for the firm. So we've just discussed that operating activities are what firms do to actually create value. That is, buying and selling their goods and services is used to create value. They're hopefully generating a return on equity above their cost of capital. Financing activities, on the other hand, do not create value, but they can influence our return on equity calculation. However, the traditional DuPont analysis had problems in that our financing activities could still influence our profit margin as well as our leverage. So what we're going to do next week is we're going to learn about the advanced DuPont analysis. Advanced DuPont analysis allows us to break down our return on equity into the components of operating returns and financing returns. And it's going to allow us to compare the operations of different firms and really understand what's creating the value, stripping out the financing effects. However, to do that next week, first of all, we need to reformat the financial statements, which is our goal today. So reformatting the financial statements involves classifying every income statement item and every balance sheet item into either operating or financing activities. So next up, we're going to go through some examples and go through the steps of how we actually reformat the financial statements.